Good afternoon, this is Sean Golding with Golding & Golding, here to go through the basics of the 3 and 5 foreign pension pillar system, how it works with U.S. tax and reporting. It used to be always a 3-pillar, then the World Bank updated it to 5-pillar. In order to go through just the concept itself, we're going to base it on 3-pillar, okay? That's how most people still conceptualize it these days. Many countries utilize it, not all countries, but many of them do. The idea is this. You've got Pillar 1, which is old age Social Security type equivalent, normally doesn't have its own bank account or its own separate account like a 401k does. And then down the line, when the person reaches a certain age or disabled or retires, they're able to take monthly distributions like annuity. And then you've got Pillar 2, which is equivalent to occupational, equivalent to like a 401k in the U.S. The big problem with that will be, and we'll get to in a moment, in the foreign country you're deriving the benefit, there's normally tax deferred treatment like a 401k is tax deferred in the U.S. But the U.S. doesn't necessarily accept that tax deferred treatment on a U.S. tax return, so it can get dicey from a tax perspective. Pillar 3 is personal pension, sort of like an IRA, okay? And these are how most foreign countries handle it. Now, how the U.S. taxes the foreign pension, depending on what pillar it is, depending on what country it is, whether there's any specific agreements, double taxation agreement, treaty, things of that nature will determine whether or not it's taxable, the contributions, the growth, distributions. In addition, there's also reporting requirements, right? These are foreign accounts, foreign financial accounts. So there may be FATCA, FBAR, Form 3520, 3528, 8621, etc., etc. Why don't we go through the basics? So the Pillar 1 is equivalent to your Social Security, okay? Typically there's no separate account for it in the foreign country. You can't just cash it out at some point. Normally, it grows by you making contributions, and then that will determine what type of defined benefit you get down the line. Monthly payments normally, right? Some countries you can deduct the Social Security out of the actual tax return. Do you report that on your U.S. tax return? Well, you wouldn't deduct it from your U.S. taxes, right, unless there's some specific agreement. Now, if you're paying into a foreign system, you may not have to also pay into the U.S. Social Security system during that time if it falls under a totalization agreement. And the idea is, if you're in a foreign country, you're paying into that foreign country's Social Security system or equivalent, you shouldn't also have to pay into the U.S. Social Security system at that time because you're not working in the U.S., you're working for a foreign employer. There's only 24, 25 totalization agreements. They're not all identical, although most of them are similar. So you want to look into that because you don't want to double pay if you can avoid it, right? And the idea of double paying, thinking that you're just going to get Social Security from 2 different countries, well, there's also things like the windfall provision, so things to keep in mind. Pillar 2 and Pillar 3 are more of your occupational and private pension. The Pillar 2 is a 401k equivalent. Pillar 3 is personal. So the idea is, in these foreign countries, they have the 401k equivalents. Now, in the U.S., you make $100,000, you put 10 of it into a 401k, that 10 is not going to be grossed up in your salary, you only pay $90,000, tax on the $90,000. In the foreign country, it probably works the same way too, but the U.S. may not accept that. So if there's no treaty, then for sure, 99% of the time, you have to include the full $100,000 salary in your U.S. grossed up income, even if 10% of it, let's say, went into a foreign pension plan. If there is a treaty, then you may be able to get away with not including the contribution if there is some tax deferral portion of the treaty as to contributions made into a foreign pension. But most of the time, there's not. So most of the time, you're going to have to pay the full amount of U.S., you're going to have to include the full amount of gross income in your U.S. tax return unless there's some specific treaty portion that says you don't have to. Now, when it comes to the growth, if you're in a non-treaty country, like let's say you've got a CPF, the growth within that is taxable, which is absurd. So the contributions you make into the foreign pension, non-treaty country, right? Contributions you make into the foreign pension are typically going to be taxable in the U.S. and the growth as well, because there's no tax deferral, there's no treaty. Now, when there's a treaty country, unless it's a highly compensated employee or some other nuance, for the most part, until you start receiving distributions from the foreign pension, the growth within it is not going to be taxable. That is not a hard and fast rule, but the general consensus among practitioners is that, hey, it's until you're receiving distributions, it's a foreign pension, there's a treaty, and so you don't have to pay tax on the growth within there. It may not even be considered what's called available. Okay. When it comes to the reporting generally goes on the same common forms that you would find for any foreign bank account. You've got your FBAR foreign bank and financial account reporting FinCEN Form 114. You've got FATCA Form 8938. You may have a 3520 and 3520A as an Apple reporting, because technically foreign pensions can be considered employment trusts, but there's certain revenue rulings, for example, that you don't have to file the RRSP in Canada, for example, and there's RevProc 2020-17, which basically eliminates the reporting for many of the foreign pensions on the more detailed 3520, 3520A form, and you may have an 8621 PFIC requirement, especially when you're receiving distributions or you have control over how the investments are being made. If you're out of compliance and you want to consider getting into compliance, there are lots of amnesty programs available. There's voluntary disclosure, VDP, for people who are willful or just can't certify under penalty of perjury that they're non-willful, streamlined filing compliance procedures, domestic and foreign, depending on the residence of the taxpayer. There's delinquency procedures and reasonable cause. We have lots of free information available on our websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.